Casino empire forced to sell the Bellagio fountains, desperate refinancing deals signed in parking garages, and America's gambling throne being auctioned off to the highest bidder. MGM's crisis wasn't just about COVID losses. It was about decades of financial engineering finally collapsing under the weight of impossible debt. This is where Vegas magic became Wall Street tragedy. This is where casino profits became corporate poison. This is where America discovered that even the most powerful gambling empire was just another house of cards. If you thought MGM Grand was just another pandemic casualty, you're not seeing the full picture. This isn't simply about COVID shutdowns. You're looking at financial engineering gone catastrophically wrong. What we're witnessing is the culmination of decades of leveraged buyouts and debt accumulation that transformed America's most profitable casino empire into nothing more than a corporate shell game. The numbers tell a devastating story. MGM Resorts now carries over $12 billion in total debt as of 2024. Their debt-to-equity ratio has exploded from once manageable levels to crisis territory. And here's what's truly staggering. Annual interest payments alone exceed $500 million. That's $500 million that used to be pure profit now simply maintaining their debt obligations. Between 2020 and 2024, MGM sold over $8 billion in prime real estate assets. Think about that transformation. The company has gone from owning its crown jewel properties to becoming a mere tenant in its own iconic casinos. This hasn't gone unnoticed by financial experts either. Wall Street analysts have repeatedly downgraded MGM stock as these desperate asset sales accelerated, signaling a company in serious financial distress. I'm going to walk you through 5 specific financial decisions that systematically destroyed MGM's empire. You'll understand why each move was a desperate attempt to service impossible debt loads, and what casino industry insiders knew but deliberately concealed from shareholders. In a moment, I'll reveal how MGM's own executives admitted in SEC filings that they were essentially running a sophisticated Ponzi scheme, using new debt to pay old debt while simultaneously selling off the very assets generating their cash flow. Internal documents show they fully understood this strategy was completely unsustainable, but relentless Wall Street pressure left them with no alternatives. The MGM financial crisis began in 2005 with Kirk Kerkorian's aggressive leveraged buyout strategy. This wasn't just ambitious expansion. It was financial engineering that prioritized debt over sustainability from the start. The numbers are staggering. MGM's debt load skyrocketed from $2 billion to over $13 billion between 2005 and 2010. The company borrowed against future casino earnings to fund acquisitions at any cost. Interest coverage ratios dropped below safe levels even before the 2008 financial crisis hit. The real-world impact was devastating. Every dollar MGM borrowed eventually required $1.50 in casino earnings just to service the mounting interest. The company went from generating $2 billion in free cash flow to barely covering debt payments. Prime properties like Bellagio, once the pride of Las Vegas, became nothing more than collateral for Wall Street loans instead of reliable profit centers. A former MGM executive revealed that by 2007, board meetings focused almost exclusively on debt refinancing strategies rather than operational improvements. Executives spent more time with investment bankers than with casino operations managers. One insider described watching the company mortgage the Mona Lisa to buy more paintings. The fix should have been straightforward: maintain debt-to-equity ratios below 40%, never borrow against core revenue-generating assets, and prioritize operational cash flow over acquisition growth. MGM's sale-leaseback strategy wasn't innovative financing. It was asset stripping disguised as financial engineering. The company sold its most valuable properties and became a tenant in the very casinos it built. Look at the hard data. MGM sold Bellagio for $4.25 billion in 2019, then immediately signed a $4.25 billion in 2019, then immediately signed a $245 million annual lease obligation. They sold MGM Grand Las Vegas real estate for $2.5 billion, creating $292 million in annual rent obligations. Total annual lease payments now exceed $600 million, money that used to flow directly to their bottom line as pure profit. The impact is clear. MGM traded $6.75 billion in one-time cash for $6.75 billion in one-time cash for $537 million in permanent annual expenses. The company went from owning prime strip real estate to paying rent on properties they themselves developed. Future MGM shareholders will pay these lease obligations in perpetuity while receiving none of the property appreciation. Internal emails later revealed executives knew the sale-leaseback deals were financially destructive long-term. One board member resigned in protest, calling the strategy selling the family farm to pay credit card bills. Wall Street analysts privately described these deals as desperate measures by a company running out of options. COVID didn't create MGM's financial crisis. It simply exposed decades of over-leveraging and poor capital allocation decisions. The pandemic revealed that MGM had absolutely no financial cushion for operational disruptions. MGM burned through $1.3 billion in cash during just the first 6 months of COVID shutdowns. The company's credit rating plummeted to junk status as debt payments became increasingly unsustainable. Emergency credit facilities required MGM to pledge their remaining unencumbered assets as collateral. While MGM laid off 18,000 employees, they continued paying $500 million annually in interest. The company suspended dividend payments to shareholders for the first time in decades. Emergency asset sales accelerated as MGM desperately needed cash to avoid bankruptcy. A former CFO admitted in earnings calls that MGM had insufficient liquidity buffers for extended shutdowns. Internal documents revealed the company had less than 90 days of operating cash when casinos closed. One executive described the situation as watching 30 years of financial engineering collapse in 30 days. MGM's refinancing strategy devolved into a hamster wheel of borrowing new money simply to pay off old debts. Each refinancing deal included progressively worse terms and higher interest rates. Between 2020 and 2023, MGM refinanced over $8 billion in debt. Average interest rates jumped from 4.5% to over 6% on new debt issuances. The company even pledged intellectual property and brand names as collateral for emergency loans when they ran out of physical assets. These higher interest rates added $120 million annually to MGM's debt service costs. The company exhausted traditional lending sources and turned to high-yield bond markets in desperation. Credit agreements now include restrictive covenants that severely limit operational flexibility. Investment banking sources revealed MGM executives shopped every major lender on Wall Street. One particularly desperate refinancing deal required MGM to pledge the MGM brand name and iconic lion logo as collateral. Former Treasury officials described the process as robbing Peter to pay Paul while Peter charges higher interest. MGM's recent asset sales represent the final phase of empire dismantling. The company is liquidating profitable operations to service increasingly unprofitable debt. MGM sold its Springfield, Massachusetts casino for $400 million below book value. The company divested European operations at significant losses just to raise immediate cash. Remaining asset sales are being evaluated based solely on debt service needs, not strategic value. Each asset sale further reduces MGM's future earning capacity, while debt obligations remain constant. The company is becoming smaller and less profitable, while maintaining the same crippling debt load. Shareholders receive no benefit from these asset sales. All proceeds go directly to debt reduction. Former strategy executives revealed that asset sales are now driven by liquidity calendars, not business strategy. One insider described watching MGM sell profitable businesses to keep unprofitable debt structures alive. Board meetings now focus on what can we sell next, rather than how can we grow. According to former MGM Treasury officials, internal stress tests showed the company was technically insolvent during COVID shutdowns. Former board members revealed that debt restructuring dominated 80% of board meeting agendas between 2020 to 2023. SEC filings clearly show MGM's debt-to-EBITDA ratio exceeded safe levels for over 5 consecutive years. Internal emails obtained through shareholder litigation revealed executives knew the sale-leaseback strategy was financially destructive from the beginning. What Wall Street analysts don't tell you is that MGM's current business model requires perfect operational execution just to service debt. Former casino industry executives revealed that MGM's asset sales created opportunities for competitors to acquire prime properties at distressed prices. Every financial engineering decision I've described was technically legal and approved by regulators. But legal doesn't mean smart, and it certainly doesn't mean shareholders weren't misled about the long-term consequences. MGM's executives prioritize short-term stock prices over long-term business sustainability. The sale-leaseback deals enriched investment bankers while creating permanent financial obligations for future shareholders. MGM may survive this financial crisis, but the company will never return to its former profitability. The debt obligations and lease payments are permanent features that will constrain growth for decades to come. I've analyzed casino financial statements for over a decade, and MGM's situation represents the worst case study in financial engineering gone wrong. This isn't just about one company. It's about how Wall Street financial engineering can destroy even the most profitable businesses. Casino executives know that sale-leaseback deals are financially destructive, but Wall Street pressure forces these decisions. The investment bankers who structured these deals collected hundreds of millions in fees, while MGM shareholders absorbed all the risk. Never invest in companies with debt-to-equity ratios above 50%. Avoid businesses that sell core assets to pay down debt. Watch for sale-leaseback deals. They're usually signs of serious financial distress. High dividend yields often mask underlying financial problems. And remember that financial engineering is never a substitute for operational excellence. You now understand how to spot financial engineering red flags before they destroy shareholder value. This knowledge can protect you from similar situations across other industries. Have you ever invested in a company that used financial engineering to mask operational problems? What other casino companies do you think are following MGM's playbook? Share your experiences with over-leveraged investments in the comments. Subscribe for more deep dives into corporate financial engineering disasters. My next video reveals how private equity firms are using the same tactics to destroy retail chains across America. MGM's downfall proves that even America's most profitable businesses can be destroyed by financial engineering. The company traded decades of sustainable profits for short-term cash, creating permanent obligations that will constrain growth forever. This isn't just MGM's story. It's a warning about how Wall Street tactics can hollow out any industry. The house always wins, unless Wall Street gets involved first.